Did I get everyone out of the waiting room? Yeah, okay, good. All right, so this is, tonight's just a refresher on basic accounting. I just wanted to go through it again just to make sure that we're all on the same page. I'm sure we are. I'm sure that everyone's had at least one semester of accounting. And, gosh, if you haven't, this'll open your eyes a little bit, but you really do need to get accounting under your belt. And as I said, I'm pretty sure everyone does, but just in case. All right, so, and some of this stuff is a little historical. But when we start to break apart balance sheets, it's still an important element to understand the difference between book value and market value of assets, especially if a company is asset rich. And from the perspective of being a lender or even an investor, that's one of the main elements of driving value. So we'll just look at that a little bit, and then understanding that there is a difference between accounting income and cash flow, because accounting income is unfortunately on paper, and cash flow is the real stuff in the bank, and cash flow is what keeps your company alive. Average and marginal tax rates is really not much more than dealing with the math of our taxation system, right? And then it's just, said cash flow is important, so you need to know how you build up or how you discover what the cash flow of the enterprise is. So look, as I'm sure you all know, there's three main accounting reports, right? Balance sheet, profit and loss statement, or income statement, and statement of cash flow, right? So the first step is we look at the balance sheet, and as you can imagine, the balance sheet is sort of the home of where you list the assets and liabilities of the business. The balance sheet has a date certain. So the balance sheet looks backwards from that date on. So on that date is when you sort of sum up all the values of the assets and liabilities of the business. It is obviously very useful information. The assets are where you can create liquidity for your business if you need to. Liabilities is what swallows the business. And as you know, the owner's equity or shareholder's equity is what drives the enterprise value of the business, right? So there is a balance sheet identity, which again, if you haven't studied accounting, all you got to do is understand this, right? It's not that scientific a business or a discipline. It's not that hard to figure out, all right? And as I said, the balance sheet identity is relatively simple. The assets of the business equals the liabilities of the business plus shareholders' equity. And if you move liabilities to the other side of the equal sign, it's effectively assets minus the liabilities of the business equals shareholders' equity. And again, just we'll talk a little bit about bankruptcy later in the semester. But as you can, this will give you actually a pretty good understanding of sort of the burden of bankruptcy. In bankruptcy, the value of the assets of the business is somewhat indeterminate, and quite often they're written down, right? Sort of like bargain shopping. The liabilities are petitioning the court to get paid, so they'll take a haircut. They'll also reduce, but they don't want to. It's not done willingly. It's done because the court sort of makes them. That doesn't leave a lot of value for the shareholders' equity. So in a healthy business, assets are going up faster than liabilities, and that's driving shareholders' equity up. In an unhealthy business, assets are dropping faster than liabilities, and that's crushing the value of the shareholders' equity, right? So unhealthy business, you're in bankruptcy. Healthy business, obviously you're continuing to operate. It's relatively easy to understand. This is a pretty good metric as to how this works, because there are sort of two sides, or two businesses, well, no, really not businesses, two focuses going on inside of a business simultaneously. One focus is I got to keep net working capital positive, right? If I don't keep net working capital positive, I can fix it short term. If I have negative net working capital, I can find someone to lend me money for a little while. It will reduce my profitability, it will diminish my shareholders' equity, but I can get a loan. If my company is operating profitably, and then my net working capital is going to keep going up. And if that happens, that's sort of the first metric of a healthy company, is we're going to keep increasing our net working capital. And what that means is current assets, which have things like inventory, cash, accounts receivable, that's going to be growing faster than current liabilities, because you're going to be paying your current liabilities out of your net working capital. The other focus inside of management of the enterprise is that we need fixed assets, or really long-term assets, not necessarily fixed, but we need long-term assets in order to run the business, because they produce revenue, whether it's patents, trademarks, plants, right? We need those long-term assets to build our business and build our revenue. And the revenue, of course, is what produces net working capital. We've only got two ways that we can finance the acquisition of those long-term assets. We either take on long-term debt, or in effect, we take the money from our shareholders. And that's because it's sitting in retained earnings. And remember that in the public markets, or really in the ownership of businesses, shareholders have a legal right to the retained earnings of the company. So on the last day of liquidation of an enterprise, when everything's been sold and everything's been paid and there's still money left, the shareholders divvy up that money, right? And they divvy it up based on their proportionate ownership of the equity of the company. So clearly, as a shareholder, your vote is to continue to have the asset side of the business grow faster than the liability side, which means that you're getting growth in your equity. It's very simple, right? When, as I said, when you hit a problem and net working capital gets very low or negative, step one is you borrow money, and step two would be that you sell off your long-term assets. Step three is you wind up in bankruptcy court. And in bankruptcy court, and for those of you who may not understand the process, the court takes over running the company. You've got two levels of the court's power in running your company. In reorganization, they leave you in as management, but they have to approve everything you do. In dissolution, in liquidation, the court takes over the sale of all your assets and the payment of all your liabilities. So even though you may still be around as management, you don't get to do much except aid in the sale of assets, right? The court decides what liabilities are going to be paid and for how much. They decide how much the assets are going to be sold for and when. And when, if you're lucky, there's some value left for the shareholders. And if you're not, then the value of shareholders' equity, kind of like a shock absorber, absorbs all that shock and it goes to zero. But that's a good little graphic to show you that.
I had a quick question. I was hoping maybe you could give some explanation for the pension liabilities, the kind of mismatch, the asset liability mismatch. Like, you know, how there's a big amount of liability on the pension side, and you know, you mentioned some strategies on how to fix that, but obviously it's a huge problem. And I was just wondering, could you explain some of the historical reason why we ended up, you know, with that kind of situation?
Okay. So you're talking about pension liability to your workforce?
Yeah, just in general, like how it's grown over the years to kind of a point where it could be unmanageable. But I was just kind of wondering the historical origins of that, or like, you know, that kind of thing.
Okay, so let me insert a little, you know, sort of a little history and discussion about that right now.
Okay.
So the thing about retirement in America is it didn't really exist until the Depression. And then Roosevelt, you know, put in Social Security. The rise of the labor union in America came about starting with the 20th century, and the labor unions were focused on three things: fair wages, better work environment, and retirement. So eventually what happened was that the court system turned to these companies and said, okay, if you put a retirement plan in, it's got to have two elements to it. Number one is you can't manage it. You can't be the trustee that manages that retirement plan because we don't trust you. Right? We saw from 1890 literally up to World War II, 1940, we watched company after company invade the employee's pension plan, right? And what they would do is they would issue debt to the pension plan, and the pension plan would, you know, would invest in the debt the same way they would if the debt was U.S. government debt. And so when the company failed, if it did, the debt became worthless, and the you know, company's employees took a real beating. So the court said, okay, new game plan. You have to have a trustee. It's got to be in a separate trust, not dependent on the operations of the company. And the company has to be legally obligated to put money into that pension.
Mm-hmm.
Right? So, when pensions first started, they were a defined benefit, meaning that the company would agree with your union that after 25 years of labor at the company, you would get 10% of your last year's salary every year for the rest of your life, for as long as you live.
Right.
That's defined benefit. And there were two parts to that, right? One part is the company said, oh yeah, no problem. We're just going to fire everybody at the end of 23 years. You got to be here 25 to get a pension? No problem. We'll just fire everyone at the end of 23 years. We'll owe no money. I love that. Mm-hmm. So that's when federal labor laws came in. And one of parts of the federal labor laws was that they made the pension right, a right that you earned over time, not just all at once. So, as you know, now in most companies, you become eligible for your pension starting within a year, generally, of employment, right? And then, but companies complained because it was eating into profitability, so the government said, all right, along with defined benefit, we'll give you a defined contribution right. Now we're going to let employees start to accrue pension benefits after a year. We're going to do it by them taking a percentage of their salary, agreeing to save it, and then the company can match it. So we went from defined benefit only to defined benefit or defined contribution, and then companies realized it was much friendlier to go to defined contribution, which is what almost all pension plans are today. Okay? But in the process, what happened was that defined benefits, became a legal right. So if I work at the company, say I start accruing my benefits after 5 years, and I work in the company for 15 years, I have a legal right that the company must meet to pay me my benefit.
Right, the contribution, right.
right? And then so the government got concerned. They were like, you know, what's going to happen if in 10 years the company just says, you know what, I'm not paying anyone's benefits. We got the money, we have money in the trust. The money's going to have to be sufficient in the trust to pay everyone's benefit. And if it's not, too bad. I don't care, right? The government said, no. You have a legal obligation to pay your employees a retirement benefit, right? Remember, that helps our economy, right? Remember that when someone retires, they've only got 3 places they can go for money. Their personal savings, which is, in America, great. Social Security, which is okay but not terrific, and corporate benefits. So the government doesn't want to have all these older people wandering around not being able to afford housing and not being able to afford medical care and not being able to afford food, right? So they're like, all right, corporations, you've legally agreed to pay these people. We're going to put this obligation on your balance sheet. And this is where a lot of companies went from defined benefit to defined contribution, because the defined contribution really doesn't hit their earnings. The only thing that hits their earnings is when the company agrees to match your contribution to your retirement plan.
Yeah.
Right? So as corporate management, you've got 2 potential retirement plans here. One is you tell your employees to start saving money and you'll match it when you can afford to match it on the corporate level. Or the employees accrue a benefit that eventually they're going to get, that's a percentage of their compensation.
Mm-hmm.
Right? That second option hits the earnings statement every year of companies. This is why hedge funds were created, because corporations couldn't earn enough to meet their pension obligations.
Low yields, got it. But yeah, it's not earning enough that's why the imbalance grows.
Right. So the corporations are making deposits into the pension trust every year, but the pension trust is earning only 6%, and it needs to earn 9%. How do we do that? Is we go find a hedge fund that's really good at taking risk, and we give them our money. Right. And that way we're in compliance with the pension laws, because we're just hiring another manager, but they're doing stuff that we can't do for ourselves.
Right. So it incentivizes bad behavior. It's like not bad behavior, but over risk in something that's supposed to be safe. It's marketed as safe.
Right. It pushed a lot of companies into taking on much more risk in their pension than they really wanted to. Right. And so a lot of companies went to defined contribution, because they're, whatever it earns, but that's up to you, because you get to pick in your defined contribution which flavor investment your money's going to go into. The problem is that a lot of employees weren't doing a very good job in managing the money, and so this wasn't working really well. But companies didn't like and couldn't live with the burden of having their pension contribution or under pension contribution, underfunded pension contribution, hit their operating statement. So it's still a mess. And so what we have in America is you effectively have sort of an at-risk retirement benefit, or if you're lucky, you have a defined benefit, but the entity that's guaranteeing you that benefit has to be able to deal with the funding.
Right, the counterparty risk.
Right. And that, by the way, is why a lot of municipalities and a lot of school districts and so on, for the firemen and the policemen and the teachers, use defined benefit, because they don't care.
Right.
Right? If they're underfunded, they'll figure it out eventually, which of course is wrong, because they never figure it out. So Illinois is highly underfunded. New Jersey is highly underfunded. Right? They're never going to figure it out. All they're going to keep doing is borrowing to pay off the current demands of pensioners. That's all they can do.
Right. Because yields are going up, right? So I imagine the situation would get worse, if not, before it gets better, if anything. That's why I'm like wondering, like, how are they gonna do that? How are they gonna operate, in the next 5 years?
Well, the way they're going to operate is they're going to operate, and we've almost become immune to the problems of companies being underfunded, right? But companies with labor pension contracts like GM or Chrysler or Ford, they've got some underfunding issues in their pension.
Yeah.
It's not a lot because a lot of times they go out and borrow when they just fund up the pension fund, so it doesn't hit their earnings statement.
Now the company will fail.
It's a mess. We haven't figured this answer out in America.
Right.
Right. And eventually, what I think happens? Eventually, how like during the mortgage crisis, the government came in and they just said, we'll buy a lot of your assets no matter what they're worth in order to maintain your capital at the banking system, and in order to give you the money to operate. They're going to have to do the same thing with pensions.
Yeah, they have to. I don't, I'm just trying to think of it logically, like what are steps, to try and reduce the problem over time, but it's too big,
It's way too big.
Billions.
It's way too big.
Yeah. All right. Thank you so much, Professor.
Sure, you're welcome.
Appreciate it.
So anyway, we've been through this, and as I said, the shock absorber on this chart here, on this graphic, is shareholders' equity. And shareholders' equity is clearly important, right? So here's, as I said, we sort of work through this a little bit. Net working capital is really important. It's very simple. It's your current assets, your inventory. And remember, inventory comes in 3 flavors, right? Finished goods, work in progress, and raw materials. So you've got all your inventories and current assets, because within a year, all your inventory should turn into money. Your accounts receivable is in current assets, because within a year, all your accounts receivable should turn into money. Cash is money, so that's sitting in current assets as well, right? The current liability portion are just all your bills, from salaries to healthcare to the rent for your office to the light bill, the PSE&G, your insurance bill to Aetna. All that stuff is sitting over in current liabilities. If a firm is healthy, as I said back when we were looking at the graphic, if a firm is healthy and operating properly, well, profitably, then net working capital will be positive and will continue to grow. Right? It may not grow very fast and it may not grow a lot, but it should continue to grow. And so there's your working capital ratio, which we'll get to in a second, and that should continue to grow because it's current assets divided by current liabilities. If it's not positive, or if it starts to shrink, that's when management becomes really worried. Because step 1 is that you go to your favorite lending institution and you say, look, I need a working capital line. Step 2 is your favorite lending institution says, all right, no mas, sorry, but I can't continue to lend your company money because you're not operating well. And then you wind up in the hard money business. And so instead of paying 5 to 7%, you're paying 10 to 15%. And then they just close you up and you're done. All right. So working capital is indeed the lifeblood of corporate operations. And as financial management, it is really the first thing you look at. Once you get beyond worrying about working capital, the next step is long-term liquidity. And long-term liquidity comes down to how fast can you convert your assets to cash if you need to, right? And so if your working capital is very high, you never really get to your long-term assets. But if you hit a bad spell and the banks are starting to get worried about your loans and they're talking about not renewing your line of credit, the only option you have at that point is to sell off assets. And so now you have to look at your assets from sort of a different perspective, which is how easy is it to sell this stuff? And then, this is why every bank in America has a fairly sizable government bond portfolio, because if you needed to, if you were a financial institution and you needed money, it's relatively easy to make 3 phone calls and sell hundreds of millions of dollars of U.S. government debt, right? So that's one of the decisions you have to make as financial management when you decide to invest in a long-term asset like a building, right? How easy is it to sell a building, right? Now, we just came out of an unprecedented period in our country where literally, at least on the residential side, if you wanted to sell a house, it could take you as little as a day, right? I mean, I read stories where houses were, in certain markets, were advertised for sale, and literally the next day there were 20 cars parked at the house wanting to look at it and willing to give a bid on the house right after they toured the house. And that even grew to the point where people toured the house electronically through Realtor.com or Trulia, right? They toured the house electronically and bid on the house right after their electronic tour, right? So you've got, as management, you've got to be very aware of what is the speed with which you can convert to cash some of your long-term assets. And you may have to take a loss in that process, right? That may be part of the deal. So that's part of your analysis. The book value is $5 million. We can sell it tomorrow for $4.5 million, right? We've got enough shareholders' equity and retained earnings to take the loss, and the loss has some positive tax aspects, and we need the $4.5 million, and this buyer's got cash. Let's do it, right? So these are sort of the variables that you put into your thinking, and this game planning is a big part of what you do as financial management. And let me tell you that only in the last 10, 15, let's say 20 years since the dot-com boom ended, only in the last 20 years have we developed a new type of corporation where they don't worry about their access to debt as much as they worry about the cash on their books, because they're generating so much cash flow. So Microsoft, Google, these companies are generating massive net operating cash flow. So they don't so much worry about access to the debt markets. GM, Ford, they're still worried about being able to borrow money because they have a seasonality of their business. They have expensive inventory, right? And they can't afford to sell off long-term assets. They need them to build the cars. So there's a real balance in financial management that you're always worried about, all right? And as I said, as much as there's a balance sheet, the balance sheet formula is very important, right? And so remember what I said, that assets minus liabilities equals your shareholders' equity. And I won't bore you by taking you through the sample balance sheets in here. You can do that yourself. Back in the dark ages, when it was a little bit harder to figure out the market value of assets, it's a lot easier today. but back when it was a lot harder, there were analysts that specialized in figuring out what is the market to book ratio of companies that were asset rich. So, if you go back, you got to go back a little bit in history. Go back to the period between 1890 and, let's say, the end of World War I, 1915, even into the 1920s. There were parts of New York City that were primarily manufacturing centers, like Queens, right? So there were companies in Queens that had big pieces of property on which they had their manufacturing plant and on which they manufactured their products, stored their inventory, and so on. Well, as Queens became gentrified and there was demand for housing in Queens, a lot of those companies moved out to New Jersey, right? And they sold off that property, and they made a lot of money on the property they owned. So there was a lot of effort spent, especially, as I said, on Wall Street, on the side of analysts, trying to figure out for companies that had very important assets on their books, like real estate, land, and so on, what is that stuff really worth? And that's the book value. And obviously, if the asset's going to be sold, it's going to be sold at the market value. And if the book value is substantially less, so you've got hidden market value on the books, that can be very important and very profitable for the enterprise, right? And so the question now becomes, right, if you're going to peel off some assets, why and what impact do you want? So if you think about it, right, if you had a loss, if the book value was very high and the market value was relatively low, right, then if you sold it, you take a loss. Well, that loss is tax deductible. It's actually a direct deduction off your income. So if you had a really big year at your company and hang on 1 sec, sorry. Oh, excuse me. You had a really big year in your company, and you wanted to smooth earnings. One way to do it is you could sell off something you have at a loss. And this, by the way, is how a lot of portfolios are in the public side are managed. If you had a really good year and you're up, 30%. Now, part of it is you got to be careful what your peer group's doing, but that gives you some buffer to sell off some stocks where you might have losses, and you want to turn that position into cash. So you take a loss on that position, and that reduces your profits. And that's done a lot in portfolio management. So this process of market to book is very important in managing the asset side of the enterprise. Okay, so that's your balance sheet. Next up is the income statement, right? And an income obviously is relatively simple, because it's your net income, the bottom line here on the slide, that is going to drive retained earnings. And retained earnings is what's going to drive the value of your shareholders. And so, as financial management, part of your job is to drive the value of the shareholders and make them happy. Because if they're not happy, they're probably going to fire you. So it becomes sort of personal, right? And most management teams don't own a lot of the company. Not to say they don't have an interest in the company, because between options and warrants and just general purchases by management, they have some shareholdings. But in general, which we've talked about, what we will talk about is the agency problem, where management doesn't own a lot of the company, and so you have to make a decision about the bottom line, right? Because the bottom line is going to drive retained earnings, and it also is where you pay dividends to shareholders. And the dividends are a whole another story, which I'll get into as we get deeper into the public markets. So effectively now, the income statement obviously affects the balance sheet, and it's clearly the other important accounting statement that you have in a company. And it's a relatively simple formula. right? Your net income equals your revenue in the company minus all the expenses. And so you can see very simply from this formula that one of the things that you can do that can have a positive impact as senior management is you can manage your expenses properly. Manage them, you don't want to be too cheap, because then you're setting the company up for all kinds of problems. On the other hand, you don't want to spend too much money on expenses, because then you're going to set the company up for a big problem. And this, by the way, was sort of lost during the whole dot-com boom and bust, right? So the dot-com boom, which started about 92, and it ended around 1998, 1999, a lot of these companies were given a fair amount of money to invest in the business and run the company. And they just had this notion that the company, in order to get really good employees and really focused employees who were willing to give their all to the business, they had to do things like provide a really nice lunch on a Friday and have a game room with a pool table and foosball tables, and have masseuses come in once a week and give massages to everyone in the company. It was nuts, right? They literally just threw money out the window, and it wasn't their money. They didn't earn it. It was invested or loaned to them. And so the problem with outside capital is that outside capital is given to an enterprise with one expectation only. And that expectation is that the company will provide that capital with a positive return. With a loan, it's much more defined as to what that return is, and when the money has to be paid back. With equity, there is no payback period, but the equity investors expect to see positive growth to the value of their ownership. And if they don't, they're going to be upset. And so step one is you get denied access to outside capital, and step two is they put new management in. And during the dot-com boom, when you had a lot of people who really didn't have strong financial backgrounds running these enterprises, during the dot-com boom, when they were putting in, as I said, pool tables and foosball tables and a bar in the corner and nice lunches and masseuses and all that sort of stuff, and you could bring your pet to work, and they hired dog walkers to come in and walk the dog for you. I mean, it was nuts how they threw the money around. Eventually, outside capital walks in and goes, listen, you're not making any money. There is no bottom line here, right? But you're doing a really good job of spending money. And so the management would go, well, gosh, we can't hire people unless we provide them with a foosball table, a free lunch, and a weekly massage. We just can't hire good help. And that, of course, was wrong, but that was the prevailing theory of management at that time. So there was no bottom line, and that's why the dot-com boom turned into the dot-com bust. All right? And frankly, that's a little bit of what happened during the mortgage crisis, right? So again, I will save you from going through the sample financials in here. You can look for them. These slides, I believe, are posted. If not, I'll make sure they are after class. So this'll, you can go through those sample financials if you want. So now, we've got our two main financial statements, balance sheet, income statement. Here's sort of the wrinkle. And remember, before 1929, there was no standard for financial statements. You could construct your financial statement for your company any way you wanted to. And you could realize your revenue any way you wanted to, under any principle you wanted to, and you could realize your expenses any way you wanted to. And so clearly, it was relatively easy to make your company look better than it was, the speed at which it was operating, right? Made it look safer and more profitable than it really was. That's why we put in GAAP, generally accepted accounting principles, right? And GAAP has in it the matching principle, which says we're not going to recognize revenue until it's fully earned, and we're going to match our expenses to our revenue, so that in that quarter, there's a direct correlation between revenue and expenses. Here's the real truth. The real truth is that the police, to make sure this happens, is your auditor. So effectively, when your auditor comes in and looks at your annual, looks to do your annual audit, they will look back on your quarterly statements. They will definitely look at your annual statement, because that's what they do. And they're going to issue an audit letter on your annual statement. Okay, so they're going to have an opinion as to what kind of a job you did in recognizing revenue and recognizing expenses that help generate that revenue. But you're paying your auditor a lot of money to get that audit letter out of them. They're not doing it for free. They're not working for the government. They're not hired by your shareholders. They're hired by management, and really the board of directors. And management clearly has a big influence there. So if your auditors come in and go, oh, you did a really bad job. You recognized revenue this quarter that really should be attributable to next quarter. And you deferred expenses from this quarter into next quarter. So you made the company look a lot more profitable. Okay, you're fired. Thank you very much, but we're not going to pay you. You're fired. You're out of here. We're going to get ourselves new auditors. See you. So there's that problem. And let me tell you what, Elon Musk, this is what he did the first year that Tesla was profitable, right? And there is some discussion that you can have with your auditors, right? It's like, okay, I've got all these, reservations for cars that people paid for. They paid real money. I've got the cars finished to deliver to these people, right? If I can't recognize the revenue of selling them the cars this quarter, then I shouldn't have to recognize the expenses of building the car this quarter, even though I did have to pay salaries, even though I did have to pay for raw materials. There's got to be some matching here. There's a fair amount of wiggle room in this process. And it gets really big when you're a private company. Right? When you're a public company, you've got shareholders, you've got analysts looking at your company, you've got the Securities and Exchange Commission looking at your company, you've got FASB and AICPA and your auditor looking at the company. So there's a bunch of eyes that, if they want to look, will have an opinion. A lot of times they don't look. Right? A lot of times the auditor says, look, we love you folks. You're doing a great job. You're working really hard. We understand how important this is. We looked at your loan agreement with Citibank, and we understand that it's really important that you generate a profit this quarter or this year. And, there's some wiggle room as to when you recognize the expenses, because you're going to carry inventory over into the first quarter. And so theoretically, those expenses could be realized in the first quarter next year. And you've got some revenue. You built the product and it's ready to be shipped, and you've shipped it, but we know that you're not going to get paid for 60 days on this stuff. So we'll help you. We'll help you recognize some of the revenue this quarter. We'll help you recognize some of the expenses this quarter, right? And we'll defer some stuff for you. And the net effect is that we'll issue you the audit letter you need, and we'll help you with your earnings. And that happens all the time, right? And a lot of people would tell you it's a victimless crime. But that's the way it works. And let me tell you, it's way worse in a lot of countries, right? We're relatively pristine here in America compared to some of the other countries overseas. So GAAP says you should match. The reality is there's some judgment you can apply to matching, all right? And the non-cash portion obviously has some very important aspects, all right? So the deduction of non-cash items from your expenses, which reduces your taxable income, was put into place by our government as an incentive to companies to invest in their business. So, when you buy a building, that building depreciates over time. When you buy a piece of machinery to produce your product, that piece of machinery depreciates over time. Automobiles you buy depreciate. Trucks you buy depreciate. Ships you buy depreciate. Rail cars you buy depreciate. So all this stuff, the government said, look, we'll give you an incentive to go out and borrow and buy these assets. And in fact, if you think about it, this is where the tax code gets sort of unfair compared to individuals, because you and I can't really depreciate very many assets. When I own a car, it's depreciating every day. I use it to get back and forth to work, but I can't deduct the depreciation. I get an allowance to deduct expenses, thankfully, but I can't deduct the interest paid on my auto loan. Right? So there's a disequity in the tax code regarding corporations. So you can sort of see the government's propensity to help these companies out. And that's because, of course, they're employers and they've got a lot more money, right? So effectively now, right, we're trying to build a fair picture of how we're managing the company, but we've got, as I said, a bunch of wiggle room. And as management, there are certain decisions that we can make within the regs or within the boundaries of the regs that lets us make the company look better or potentially worse, depending on what we need and what we want, right? Clearly, one of the elements is managing time. And the way we manage time is by managing our costs as to either fixed or variable, right? And fixed costs don't go away. I mean, I don't know if you saw Bed Bath & Beyond may have to file for bankruptcy. They're in violation of their loan covenants, right? Well, what they did was years ago, they put a lot of real estate on their balance sheet. So all those Bed Bath & Beyond stores, those aren't franchise operations, those are corporate operations, and Bed Bath & Beyond either owns them, though I think they've sold most of what they owned, or I think all of what they owned. The rest of the stuff is leased, right? So they have a legal obligation for the term of that lease to pay rent, period. Their lenders said, you got to reduce the number of stores, right? The world's moving online. Go fix up your website, keep pushing revenue into the website, and close all these stores because you're not doing enough business in the store to justify keeping the store open. You've got employees, you've got inventory, you've got rent. Stop it. Right? And if you don't stop it, we're going to stop lending money to you. So the problem is that Bed Bath & Beyond has a high fixed cost factor, and their lenders were saying, please turn your fixed costs into variable costs. And they didn't listen. So now they may have to go there. The lenders have a right to call the loans. They may call the loans. That will push Bed Bath & Beyond into bankruptcy. So if you're thinking about buying some new towels, wait a couple of weeks and you may get a bargain. All right. And that all this stuff isn't necessarily obvious on the balance sheet or financial statements. You got to drill down a little deeper, and that's part about being an analyst. The other thing that management likes to do is smooth earnings. And that's because of expectations. So if your company has a great year and earnings shoot way up, what are you going to do next year? Right? You're either going to surpass those earnings by just normal earnings growth, or you're going to have to explain why you didn't surpass those earnings because that was an aberration and not normal growth. Right? So one way around that is you can smooth earnings. And that means, even though, as I said, GAAP has regulations, there's sort of boundaries. It's not a law. It's not hard and fast, a hard and fast thing you have to do. So what you can do, thanks to the wiggle room in GAAP, is you can smooth earnings by moving, as I said, this quarter or some of this year's revenues into next year, and by moving some of next year's expenses into this year. So, theoretically, you could take fourth quarter earnings and move them into first quarter next year, and then you could call up all your vendors and go, hey, I'd like to buy some of next year's inventory and have you deliver it before December 31, please. And by doing that, you're going to move some of next year's expenses into this quarter, and you're going to move some of this quarter's earnings into first quarter next year, which gives you some sense of comfort as management about operating the enterprise, and it smooths out the earnings if you have a big earnings spike this year. And that is done a lot. That's almost standard operating procedure for a management team in the current environment in our financial markets. The last thing that's happened in earnings management is, which actually is making the job a little easier, is that if your company is global and you've got international operations, part of that problem is eventually you have to consolidate all your various bits and pieces back to a U.S. financial report. So what's happened, because globalization has become so important, is that we've adopted sort of a new accounting standard called IFRS, International Financial Reporting System, which effectively gets rid of some of the differences between GAAP and what happens outside of America. The problem is enforcement, right? And that is going to be, yet again, another issue. There's some enforcement at GAAP, but there's not very stringent, focused enforcement at GAAP. Well, and the enforcement at GAAP is sort of left up to your auditor, and both your auditor who wants the fee and the company that knows that the auditor wants the fee, and the company has the right to to fire the auditor, right? The auditor is not a really good police person for GAAP compliance. It's even worse with IFRS. So we haven't figured out yet a really good compliance system for GAAP accounting, but it will probably come over time. And look, and all of this stuff for public companies winds up on the desk of the SEC. So here again, the SEC was an entity that was created, after the crash because of these problems with reporting and problems with just general oversight in the marketplace. I mean, believe it or not, in 1927-28, when the markets boomed, there were a lot of phony companies that got started that went public. So, all you had to do was conform to the listing requirements for the American Stock Exchange, which had easier listing requirements than the New York Stock Exchange, and you could go public. So you could take your company not in a major city like New York, but out in Ohio, and you could take your company public, and it could get on to the American Stock Exchange and acquire shareholders, and the company didn't really exist. And by the way, that level of fraud doesn't really exist anymore in the private markets. It does exist a little bit. In the public markets. It does exist a little bit in the private markets, but where it exists substantially is in Medicare fraud. There's a huge amount of Medicare fraud being perpetrated by medical facilities that don't really exist. They rent a building, they put up a sign, they have a couple of people that show up every day and walk around in white coats, but they don't really, they don't really see patients, and they've stolen, tax ID numbers and Medicare account numbers, and they bill Medicare and they get paid. And there's been a lot of that that's been discovered over the last 10 years. So this, unfortunately, this sort of stuff is not going to go away. And having the SEC have oversight is great. The good news is that the SEC has made much more transparent the filings that they get. So they have this site called Edgar. And if you go to sec.gov, Edgar is a button over on the upper right of their homepage, and you click on Edgar, you put in the symbol of the stock you want to investigate, and up pops all the SEC filings over the last couple of years. So all the 10Qs, which are quarterly, and the 10Ks, which are the annual, and the 13Ds and the 8Ks, which are forms stating substantial financial change to the operations of the company. All that stuff finds its way into Edgar. And in the old days, you had to write the company and ask them to send you the filings, which they might not do. You had to go to a library to see if the library had them, and the library could request them for you, or your company would request the statements and get them from the company. It was a mess, right? The provision of information was really hard, going back, really before the internet. I mean, just so you get a sense of how big a deal this is, one man saw this as a terrific opportunity to build a very profitable business. And that man is Mike Bloomberg. And because he understood that the demand for information was going to continue to grow, but the provision of the information was not yet built, because the internet was still very new when he started Bloomberg and Company, Bloomberg Inc. He's worth $65 billion today, right? And Bloomberg is a huge provider of financial information, from annual reports to research reports to trading data. It's all in this one website, and it's sort of the go-to resource if you need information about a company. But if you want to validate or verify that information, the SEC site is pretty good. But let me tell you, even the SEC is not really good at getting all of the data in there. They're good with the big companies, but the little companies sometimes will drag their feet and file late and get fined and not care. So there's still some wiggle room built into the system. Taxes are an outgrowth of the tax system in America, right? So effectively, the difference between marginal and average tax rates has to do with the tax code. And so, as I'm sure you know, as the taxable income of the enterprise goes up, you pay more of that taxable income to the government, just like our taxes, just like personal income taxes. The difference is that corporations have a much greater ability to both reduce their adjusted gross income, which means they pay less taxes, and the government's not really good at policing the how much taxes they pay. So, for instance, ExxonMobil, which is one of the most profitable companies in America, allocates a lot of their income out of the country so they don't pay taxes here. They operate here, their wells are here. I mean, their wells are all over the world, but they've got a lot of production here. They've got a lot of refining here. They sell a lot of gasoline at the pumps here. They don't pay a lot of taxes here. Right? So the tax system in America is just sort of broken, right? And this is why there's this concept of marginal corporate rates and average corporate rates, because it's all based on how you step up through the tax system. So again, I'm going to jump over some stuff because this is pretty simplistic, and you can figure this out yourself. But effectively, as corporate management, you take what you earn, what you're reporting having earned, and you step up through the tax table